Good day, grade 12s, and welcome to this session that we are going to do on insurance. And I'm joined here today with my good friend and colleague, Mr. Peter Edwards, and he's going to take you through the first section of the work. Welcome, Mr. Edwards.
Thank you very much, Mr. Vansel.
Right, guys, just before we start, just to show you a couple of information bits here. If you need more information, you can contact Mr. Lester Momberg on ldmomberg@gmail.com. Otherwise, you can go onto the WCED e-portal, and the website address is there for you on the screen. And also, this is a live session, so you guys can also WhatsApp us on 083-792-1239, and I will be monitoring whatever questions come in on the system. So please feel free to let us know if there's any questions that you might have. Right. Also, guys, if you want to request access to the Telematics School's website, please complete your registration form. The details are on the screen here, and you guys can write it down, and then you guys can access all of these wonderful videos that we are making for you. Right. So, guys, we are going to look, as said earlier, on insurance today. That is the focus. And I hope it's a very technical section of work this, so guys, please be awake when we do this. If this is something that you struggle with, you will find this, of course, in your paper 2 at the end of the year and in your trial exams. Right. Now, guys, I'm going to hand you over to Mr. Edwards. He's going to take you through the first section of the work, and then we will have a bit of discussion, as we always do, in between these sections. Right, Mr. Edwards, up to you.
Thank you very much, Mr. Vansel, and good afternoon to you, grade 12s. I hope you are doing well, and looking forward to your prelims later on this term. All right, so we are looking at the investment insurance part. Now remember, this investment section has two parts to it. One is the investment part, and then the other is the insurance aspect. Okay, and today we are going to be specifically looking at the insurance aspect of the work. Right, first and foremost, we're going to look at a couple of things, some terminology that's considered really important in this section of work. And the first one is the actual definition that is required for insurance. First and foremost, it says the agreement between the insured and the insurer in which the insurer agrees to compensate the insured in the event of a specified loss in exchange for a premium. Now, just to give that a couple of details there. So the insured is looking to indemnify. We'll look at the word indemnify a little bit later, but they're wanting to pass on the risk to someone else, and the risk is being passed over to the insurance company. All right. So, for instance, if there's a fire, you want to make sure that you can get the return on the loss that you may have incurred because of that fire. All right. The insurance company is not going to give that to you for free. You are going to be paying a premium. So you pay a monthly premium for that. All right. So these are the terms that you can see in your module. And please remember that you need to have your module with you as we're going through this section. These are the terms that we're going to be discussing as we go forward in today's lesson. Okay, first and foremost, compulsory insurance. Secondly, non-compulsory insurance. Obviously, that's a type of question that could come up, comparing the two. Then we look at underinsurance, overinsurance, and with that, there's the average clause that comes into play. I mentioned the premium, all right? Then the insured value, because you've got a market value versus an insured value. The concept of reinstatement and excess. All right, excess is an amount that you would pay when you claim to an insurance company. All right, so those are some terms that you'll see in your module there, and it's some of the terms that we will be discussing as we go forward. All right, so first and foremost, let's have a look at compulsory versus non-compulsory insurance. This is quite a popular question in the insurance section. a lot of the questions that you'll come across are distinguish or describe the difference, or discuss the difference between two different terms. So let's have a look at compulsory versus non-compulsory insurance. So compulsory insurance, as the term explains, it is compulsory. Refers to the insurance that individuals, businesses are compelled or legally obliged to take out. So you are required by law to have compulsory insurance. There's a couple of examples that we will look at a little bit later. Your URF and your road accident fund are some terms that will come across a little bit later. So the opposite to that would be non-compulsory insurance. These are insurances that you are not compelled to take out. So let's have a look at the definition there. Refers to insurance where the insured has the option of insuring against certain risks that may or may not occur. We'll discuss that a little bit later as to what may or may not occur, but it is important to note that these insurance possibilities you don't necessarily need or require to take out. All right, moving on to the next one over there. Insurance versus assurance. All right, so this is a very, very popular question, distinguishing between insurance and assurance. First and foremost, we'll look at insurance. This is based on the principle of indemnity. All right, the covering of losses, passing on the risk to someone else. That's the whole concept of indemnity. Right, the insured transfers the cost of the potential loss to the insurer at a premium. That's what I referred to earlier. You're not going to get this indemnification for free. You are going to be paying a monthly cost, and that's all calculated by actuaries in the background. They'll look at the risk that you pose, and the example I always say to my learners is, if you are parking your car, right, your insurance company will ask the question, where are you parking your car? Are you parking it on the road? Are you parking behind a closed gate, a locked gate, in a garage? All of those aspects result in a certain risk. So obviously, if you're parking your vehicle on the road, that's going to pass on a great more risk to the insurance company, because there's more risk that your vehicle will be broken into. Okay, so that would be you would end up paying a greater premium on a monthly basis based on that risk, and these are all calculations that are done in the background. Going back to a couple of more points with regards to insurance. It covers a specified event that may occur. Okay, note the word, it says may occur. So let's look at an example like an accident for a vehicle, a fire that might take place, theft of property, or robbery on your or in your property. These are all things that may occur. That's what the key is. So if you are wondering what insurance is, it's possible occurrences, and that's what you are covering for, specified events. Right,
Mr. Edwards, my learners oftentimes ask me about insurance. What happens if I pay the premiums every month and then nothing happens?
Yeah,
you know, I haven't claimed. Can I get the money back? Absolutely not. Guys, what you are paying for in insurance is peace of mind. That is what you're paying for. So should something happen, I will not incur all the expenses because I have insurance and I've passed it on to the insurer. So guys, it's actually a very interesting topic of how insurance work. Insurance work on the principle that those that don't need to claim subsidize those that do claim. So that is how it works. So if I'm not claiming, the money that I have actually pulled into the fund is covering someone else's loss. So that's why I can't get the premiums back. Now guys, Mr. Edwards have also mentioned that may happen. We also could say may or may not happen. I can go through 5 years of having my car and paying it off, and nothing has been broken into. I've never made an accident or any of those things. It may or may not happen. The event is not certain. The timing is also not certain. So that is why we say it's may or may not happen.
Yeah. Just keep in mind, you might have come across companies like Outsurance and that sort of thing. What they do is that they'll give you an bonus. That's one of their key things that they'll do. So if you don't claim for a certain period of time, they might give you a portion of it back, but you never get all your money back.
No, you never
Insurance companies always win, I can assure you.
No. And how they do that is they actually load your premium beforehand, that
100%.
in the event that you are not claiming, they will pay you something back.
Yeah.
So that is why they call themselves outsurance. You're not just putting money in, you might get something out.
You get something back, eh?
Okay.
All right, so moving on to assurance. Now, the main definition that we had for insurance is something that may or may not occur. Now, assurance is something that there's certainty that it will occur, and you'll see what I mean a little bit later. So let's have a look at the definition there. Based on the principles of security and certainty, something that will happen. The insurer undertakes to pay an agreed sum of money after a certain period has expired. So you'll see an example a little bit later when they talk about life insurance. Now, life insurance, you pay a premium on a monthly basis, and there's two occasions that they will pay out a certain amount. So if you've applied for a R1 million cover, for example, they'll calculate your premium, they'll look at your risk. Maybe you've got a certain disease, or you smoke, or you drink far too much alcohol, something along those lines, that will increase the risk of death. So life insurance pays out on one occasion is on the time of your death, or on a specified age. So when you turn maybe 55 or 60, then the fund will pay out. So that's life insurance. Something that will happen at some stage. So that's a certainty that it will take place. Yes. All right.
It's a certainty that it will take place, but when it takes place, we don't know. Because, I know that I'm going to die, most certainly. That is certain. All of us living, we are going to die. But I can walk across the street tonight on my way home, and a bus can flatten me, and I can die tonight.
Yeah.
And if I die tonight, the R1 million pays out. If I die in 60 years' time, the R1 million pays out. That is how it works. It's on certainty that you will get something if a certain event happens. It's like disability as well, or dreaded disease. If I get cancer, a policy pays out because I have additional expenses if I contract that kind of disease.
Sure. And just to clarify, that R1 million obviously doesn't necessarily go, or doesn't go to you if you pass away. It goes to your beneficiaries. So the whole concept is that those that are left behind are catered for, and that's main aspect that life insurance tries to cater for. Right, so life insurance is a very good example of assurance. Okay, just looking at the last 2 points for assurance, it is a specified event and it is of certainty, but the time of the event is obviously uncertain, which Ms. Van Zyl referred to earlier. It is applicable to long-term insurance. You'll find with insurance, it's short-term, and then assurance is long-term. So you'll see you'll be paying off a premium for a long period of time until you either pass away or you reach a particular age. Okay, whereas insurance, you're paying over a certain period of time, and it could happen in a short period. So you might have a theft or a fire at your property at some stage in the near future. That's why it's short-term. All right, that's insurance versus assurance. Okay, please remember, take note, this is in your book there. Ensure that you can differentiate between insurance and assurance. Insurance is a term that describes short-term insurance agreements, whereas assurance, as referred to earlier, looks at long-term insurance agreements. Moving on to the next slide. So we're going to look at some examples of short-term insurance. Okay, let's have a look at a few here. Obviously, property insurance, you can insure your property against fire, any sort of damage that's caused by that, or other sorts of natural disasters like flooding and that sort of thing. Okay, so that's property insurance. Cash in transit. Okay, so you can insure money that you are transporting from one point to the other. You can insure that against theft. All right, and obviously in yellow there we've got theft and burglary. All right, it's just interesting to have a look at burglary. Sometimes there's not people aren't too sure as to what burglary and theft. Why is it different? Burglary specifically is if there is forced entry into a property and there is someone has stolen property from, or stolen products or assets from your property. So just keep that in mind with regards to a definition for burglary.
And theft is when somebody can take your cell phone, for example. They didn't break into a property to retrieve those things.
Sure.
Then they took your cell phone. That's theft.
Yeah. Okay, so just keep that in mind with regards to the distinction between the two there. All right, moving on to examples of assurance. Note, these are long-term. Okay, so let's have a look at some examples there. Right, we've got a number of examples. Many of these function very similarly, right? Okay, we spoke about life insurance a little bit earlier. Okay, so life insurance, you'd look at a R1,000,000 cover. Depending on what you can pay on a monthly basis, you would do some calculations, and then that would be calculate as to how much life insurance you can gain, or for your beneficiary. So it might be your husband, your wife that's left behind, and the children. Okay, endowment policies, retirement annuities, and provident funds work very similarly. Okay, they are very similar to a pension fund. Many of these are used if you don't have access to a pension fund. Maybe if you're not employed by a large company that has a pension fund, many self-employed folk will go for these options. So here you would put a certain amount of money away. You would try and calculate how much would you need on retirement, or date of retirement, and you would then calculate back so that you would be paying a monthly contribution to your retirement annuity or your retirement fund. And through that, you would hope that when you retire, you have got enough money available in order to live comfortably, live very similarly to what you were when you were working. Okay, so that's investing for your future. Okay, then funeral insurance or funeral cover. It's something with regards based on your costs for a funeral. Many South Africans, funerals are very expensive occasions, very expensive events, and you don't want to be leaving that expense to your family, for example. So you would be putting a certain amount of money away so that on the event of your death, the funeral expenses are covered. All right, moving on to the last one there, health insurance, medical insurance. That is insurance for any sort of medical costs that you may incur. Right, you can see a couple of examples there, very popular examples. You might have seen adverts on TV for things like Liberty Life, Hollard Insurance, Old Mutual offers some insurance. Then you've got Compass Insure, and I mean, interesting one, even Kaiser Chiefs offers a funeral cover benefit. So yeah, many companies have got involved. Most of the banking institutions have also got these sorts of products available to their customers. All right, moving on. We're going to be looking at the principles of insurance. Now we've got 4 concepts here, right? Indemnification. I mentioned earlier that we were going to go back to indemnification just to find out exactly what it refers to. Certainty or security, utmost good faith, and insurable risk. So now these are 4 principles that insurance companies prescribe to, and they expect the insured, the customers, also to prescribe to these 4 principles.
Mr. Edwards, I just want to mention here, some textbooks mention average clause as being a principle of insurance. Guys, please take note that average clause is not a principle of insurance. There are only these 4 that you need to know. So please don't answer anything but these 4 things. Okay, so no average clause or anything like that. These are the principles, the backbone, or what makes insurance work. It can't work without any of these 4 things. All of these 4 things must be present for an insurance or assurance contract to work.
All right. We will discuss average clause. I think it's the next concept, so we will get to that, but it's not part of this section. All right, indemnification. Let's have a look there first and foremost. This applies to short-term insurance as the insured is compensated for the specified loss. So it's a whole concept of indemnifying yourself against the loss. Any specified loss, a fire or anything like that, you don't want to be having to pay out 100,000 Rand because of a fire that took place. So you are handing over that risk to the insurance company. Again, not for free, you are going to be paying a premium. All right, it protects the insured against the specified event that may occur. Again, that may or may not occur. All right, so it's protecting you against that risk that takes place.
So short-term insurance, it's applicable to short-term insurance.
100%. So remember, when we talk about something that may or may not occur, it's looking at short-term insurance. Now looking at certainty and security, this applies to long-term insurance. Now remember, this is something that's certain to happen. Hey, your death is certain to happen, where the insurer undertakes to pay out an agreed amount in the event of loss of life. Right, so if you pass away, then there will be an amount paid out to your beneficiaries, your family, okay, so that they are covered. This is a predetermined amount that will be paid out when the insured reaches a particular age, for example. Okay, so that's very important to remember. It's a predetermined amount. So if you're applying for 1.5 million Rand cover or 2 million Rand cover, that's what will be paid out. Doesn't matter how long you are paying that for. If you die, then that will be paid out to your beneficiaries. All right, moving on to utmost good faith. Right, so the insured has to be honest in supplying details when entering in an insurance contract. So the insurance contract is based on the concept of utmost good faith. So there's good faith on the part of the insurance company, there's good faith on the part of the insured, the customer. Okay, so anything that they provide, any information that they provide is truthful, is honest. Now, for example, if I'm going and applying for life insurance and I do not state that I've been smoking since I was a teenager, or I drink a certain amount of alcohol at particular days, I'm a diabetic. If I don't mention those aspects, then I'm being dishonest, and that will come back to bite me if I do need to claim a little bit later. So it requires, the insurance company requires the customers to be honest at all times. Both parties and the insured and the insurer must disclose all relevant facts. The same applies as a customer. I want to know that the insurance company has not put details in very fine print, or have not given me all the specific details with regards to a payout or something along those lines. So both parties are required to be honest.
Okay, Mr. Edwards, I think it's very important to note any contract that you enter into, an insurance contract, is underwritten by a specific company. That means that what they do is they calculate the risk of something happening sooner. So if I'm a smoker, for example, as Mr. Edwards mentioned, or I do some kind of dangerous activity like rock climbing or whatever, that influences that risk of me dying sooner. And the insurance company will calculate their premium based on that risk. And if I don't say to them that I do these risky kind of things or I have this kind of lifestyle, they will calculate an incorrect premium. So now when I die, they are going to go back and say, hang on a second, the coroner said that this guy was a diabetic. I didn't disclose that because that could have caused my death sooner, and the premium was not calculated correctly. Guess what's going to happen? They're not going to pay you. So you've paid all that premiums all the time that you were alive, and now all of a sudden your wife and kids will not get the benefit because I was not truthful.
Yep. Another example, say if you are applying for travel insurance, so maybe you're going abroad, and one of the aspects that they ask you is, are you going to be partaking in any dangerous sporting activities? And one of the things they might say rock climbing, as Mr. Van Zyl said, or scuba diving or something along those lines, and you have not ticked that box, you have not informed them that you're doing that, and for some reason you have an issue with scuba diving or rock climbing on your vacation, on your holiday, and you haven't specified that, and then you want to claim, they're going to argue, well, you didn't tell us from the outset, so we are not going to pay out. It's negligence on your part as a customer. You weren't truthful. Right, moving on to the last point there, insurable risk. So the insured must prove that he or she will suffer financial loss if the insured object is damaged. An insurable interest must be expressed in financial terms. So this is in terms of you need to be able to give specific details as to what the loss is going to be if something is stolen, for example. Now, a couple of examples that might come up. You can't insure against a change in fashion, for example. Okay, so you can't say, well, I've bought 500,000 rands worth of goods, clothing, and within a week or two you realize on delivery of the clothing, people have moved on to a different fashion trend. So you can't say to the insurance company, well, I want to claim against that fashion trend or that change in fashion trend. That is an example that could come across. So you've got to be able to prove that there is going to be a financial loss if something happens. So that's the insurable risk.
Mr. Edwards, there's also another nice one to explain this. Let's say me and Mr. Edwards, we are friends, but he's got his own car and I've got a car. So now I say, hang on a second, if Mr. Edwards, he's quite a bad driver. So I know that if he damages his car and the likelihood is good, I can score if I take out insurance on his car. But the problem is, it's not my car. I'm not receiving any damages if he bumps his car. That is for his account. So there's no insurable interest. I don't stand to lose anything if his car is damaged. So I cannot take insurance out on his car. It is very important this. Guys, even in life insurance, if you take on insurance on somebody's life, and you make sure that you cut the brakes or something on his car and he is in an accident and now I claim his life insurance. Guys, they're going to ask, hang on a second, what did you lose by this guy dying? If there's nothing, there's no loss that I've suffered because a person incurred a loss, then that's not insurable for me. I cannot take out insurance on Mr. Edwards' car. But if I paid the premium on his car, I bought a car for him and I pay the premium, then I will suffer a financial loss because it's actually my car that's damaged and I need to replace it. So then I have suffered a financial loss.
Yeah, so the point is you can't gain from the insurance contract. That's what the insurance company is trying to avoid in this situation. All right, so I am going to hand over to Mr. Van Zyl with regards to the next section, if I recall, average clause.
That is correct. Okay, guys, the average clause is actually a very important concept that they oftentimes deal with, and they're going to definitely ask you. I've marked papers this in mid-year, the June exam, and the average clause was in there. I'm pretty sure it was in last year's paper. It's always in paper. So guys, please make sure you understand this concept quite well. Now guys, the average clause is something that comes into play in case where a person is underinsured. Now, underinsurance means that I have insured my property for less than what the actual replacement value is. Now, once again, guys, when they calculate the risk, what will happen if the risk actually materializes, like my car was in an accident or my house burned down or something like that? What was the value of the property that I would have lost? If I am not truthful and I say to them, listen, my property and everything in it is only worth a certain amount, 500,000 Rand, but it was actually worth 2 million Rand, then I'm underinsured and I'm paying the wrong premium. I'm paying too little because the exposure of the insurance company is now based on 500,000 Rand, where it's actually 2 million. Then if something happens, I'm only going to be paid out a proportion of what the actual loss in value is, and that is why it's in underinsurance. And there's a specific formula that they use that you guys need to know quite well. So I'm going to show you what that formula is. The formula is the amount insured, that is now let's say 500,000 Rand, as I've said, divided by the market value. The actual value of the property that I've insured is actually 2 million Rand. So I'm going to take the amount insured divided by that market value times the actual damages. Let's say the damages was calculated at 50,000 Rand. Okay, so that is the damages that I've suffered. They're not going to pay me 50,000, they're going to pay me in proportion to that 50,000 Rand. Okay, so guys, I've got in your booklets, there was actually an example given to you, and I've worked it out for you here, so you can, if you've done it, you can mark it. It says there, and read the scenario carefully. Peter owns a thatched house valued at 1 million Rand. He insured his house with pro cover insurance for 800,000. Now remember, the property is 1 million Rand, but he only insured it for 800,000. So we now know that this is under insurance. It's less than the market value. Now what happened was a fire broke out in the kitchen, and that caused damages of 30,000 Rand. Now the question says, calculate the amount that pro cover insurance will pay Peter to cover the damages. You need to show all calculations. Question 1.2 I haven't answered, but I will do that afterwards. Right, so I've now looked at a couple of things here. He owns a thatched house that is valued at 1 million Rand. That is the market value. Right. We insured it for 800,000 Rand. That is the amount insured, or the insured amount. And then, of course, the damages they gave us there as 30,000 Rand, and that is, of course, the damages. Now that we know how to analyze this case study, we can just put it into the formula. So there's the formula: amount insured divided by the value of the insured item times the amount of damage and loss. Now, guys, that tick goes for your calculation. So in my opinion, you must always write down that formula, because that is worth a mark. Okay, so if you cannot do the calculation, you forgot your calculator at home, please always start with the formula. Right. So now what I'm going to do is just substitute all of those numbers into the formula. 800,000, which is the amount insured, divided by 1 million Rand, that is the market value, times the 30,000 Rand, which was the damages. Now, guys, if you write it like this, you show all calculations. That 30,000 is also worth a mark. And now we just punch the numbers into the calculator, and we get to 24,000 Rand. Now, guys, in an end of year paper, if you only write down 24,000 Rand, you will get all your marks. The problem is if you've miscalculated. If you've written down the formula and you've written down all the steps, then there is still some marks in it for you. I've had one this June exam where the person just wrote down the formula, and they made an error by putting the 1 million Rand over the 800,000 Rand. So with other words, the end was going to be incorrect, but he still got a mark for times 30,000 Rand. So guys, show all calculations, and even if you're wrong, there will be marks in it for you. Now, guys, question 1.2, there's no slide for that, but I can quickly tell you what the reasoning is. And if I can just quickly go back to that slide, you will see, explain to Peter the reason why he did not qualify for the full amount of damages sustained. That is because he was underinsured. To make that statement, he was underinsured, and that means he will only be compensated in proportion to the premium that he has paid on the lesser amount insured. And that is why it is actually by law like that. You cannot profit from any insurance claim. So if he didn't do that, if they paid him the full amount, he actually would have profited from an insurance claim because he insured it for less than what it was actually worth. Right. So guys, I'm just going to the next slide. Right. And that slide is the importance of insurance. Now guys, this is a very important section. The importance of insurance is always asked in a paper somewhere. You will get it. So make sure either in your trial exam or your end of year exam, you need to know this. So please make sure you know this quite well. Now guys, it normally comes in a form of discuss or explain the importance of insurance. And you can see there I've broken down the sentences into a statement and a qualifier so that you guys know to write the full thing. A statement is something like this: transfers the risk from the business, that is a statement, to where? To an insurance company or the insurer, that is short-term insurance. It protects the business against dishonest employees. Now guys, that is also a kind of insurable risk or an insurance contract called indemnity insurance. Or fidelity insurance, fidelity insurance, where dishonest employees may cost you money because they've lied to somebody or they've stolen something from you or they misrepresented themselves and you suffer a loss. You can insure against that fidelity insurance. The next one protects the business against theft, loss of stock and or damages caused by natural disasters, and also must be insured against damage and or theft. Now guys, specifically, you can see there's a lot more in the memo that you've got in your booklet. I've chosen these specific ones because guys, it's no use trying to remember all of those bullet points when you study. There's just too much facts. What I would do is remember 4 of these bullet points. Then you set for a section C and a section B question. In section B, the chances that a question will count more than 6 marks is very slim. So therefore, you only need to remember 3 of these bullet points. I'm putting in 4 for a section C and just building in some safety net. Okay, and guys, please remember the split marking, a statement and a qualifier, and I've split it for you in that paper. Right. The next one that you guys need to know is the difference between insurable and uninsurable risks. Now guys, this is a differentiate question that will also come in a statement and a qualifier. I haven't split it up for you in this case, but please, you must remember the difference, and the difference must be clear. Insurable risks are things that we can insure for. That means that an insurance company would be willing to take over that risk for a premium. Right, it is things like theft. And guys, these things, those examples that you see there at the bottom, I've seen it in a paper where they ask you to list insurable risks. Now guys, they're not asking you for insurance, types of insurance. They're asking you for insurable risks. Then you need to say to them, theft, fidelity insurance, burglary, money in transit, fire, and you can say damage to property, but don't say property insurance because that doesn't refer to damages. So that's the difference between types of insurance and you say property insurance. That's not what I'm looking for. It is the risk itself. Damage to property. That word damage to must be there. Right. Now we are going to look at things called uninsurable or non-insurable risks. And these are risks that cannot be taken by the insurance company. The risk of it happening is so big that insurance companies don't want to take on that kind of risk. Now we are looking at things like damages incurred as a result of a war. If you think about what's going on in the Ukraine, all of that property damage will not be covered by an insurance company. It's not stipulated in their contracts. The next one, fluctuations in fashion and trends, because that's the risk that the business takes, that if they put something on the market and it's not selling well, that's a risk that is incorporated by the entrepreneur, not by an insurance company. Then any new inventions that were created by the improvement in technology that you do not have access to, that is not insurable. that is unfortunately a risk that the insurer or that the company or the entrepreneur needs to take on themselves. Right, guys, I'm moving on to compulsory insurance. Now, guys, the word compulsory means that you have no choice in the matter. You have to take out these insurance. You cannot cancel it. You cannot opt not to take it out. It must be taken out. And if you can see on the slide, the picture, it is required by law. You must take them out. And guys, there are 3 compulsory insurances that you guys need to know quite well, and you need to be able to discuss it in a lot of detail. Right. The first one is the Unemployment Insurance Fund, or UIF. Now, guys, if you look at the 2 pictures there, that's the 2 main things that normally is claimed for. The first one is if a person is retrenched. You can see there the company has restructured and that guy is no longer necessary, so he lost his job, and that means he's going to be out of pocket for a while until he finds a new job. The other one is maternity benefits. That is if a lady becomes pregnant and she needs to go on maternity leave for 4 months. And if you could think back to the Basic Conditions of Employment Act, maternity leave is unpaid leave. So how do these people survive in the 4 months? They survive on the UIF benefits. Now, guys, let's just quickly look at the different benefits of UIF. The Unemployment Insurance Fund was established to assist employees with financial aid should they become unemployed due to the termination of the employment contract by the employer. That is if they get retrenched. Now, guys, please make sure you see the ticks and to know that where the statement and the qualifier is. Right, the next one says, the UIF provided financial assistance for a limited period to the dependents of a deceased employee, not forever, to the dependents of a deceased employee. If a person actually died and now their family lost that income of that breadwinner who has died, they can claim from the UIF for a certain period of time. Right, only if that person was registered for UIF, and if he works for a business, it is compulsory, he had to be. The employer, now guys, there's more bullets in your booklet than what I've got here. I've just taken out, I wanted to do 4, but I've put the 5th one there because what is very important for you to know is how it is funded. And there are specific things that you need to know, and those 1% and those, you guys need to know that quite well. So the next one says, the employer is required to register their employees with the UIF and to pay the levy of 2% of the employee's remuneration. So if a person earns a lot more money, that 2% is going to be a lot higher than a person that's earning less income. Right, you need to pay that over to the South African Revenue Service every month. Now guys, that 2% can be gained from the employee as well, because the employee contributes 1% of her salary or remuneration towards UIF, and the employer contributes the other 1%, an additional 1% of the employee's salary towards UIF. So the employer and the employee pays for this, and it's compulsory. You have to take this out. Right. The next one that you guys need to know in terms of compulsory benefits is COIDA, or the Compensation for Occupational Injuries and Diseases Act, the Compensation Fund, and that pays out if a person is injured on duty or while performing his duty. Right. All employers are compelled to register with the Compensation Fund so that employees may be compensated for accident and diseases sustained at the workplace. Now guys, the levy paid to the Compensation Fund is the responsibility of the employer only. The employee does not contribute towards this fund. Now guys, you can see there that there's no 1% or 2% or 3% or whatever. That is because certain jobs takes a higher risk than others. If you are a person that works with heavy machinery, the likelihood of you getting injured versus, let's say, teachers is a lot more. So therefore, the premium that the employer needs to pay to the compensation fund is also going to be a lot higher, because the likelihood of something bad happens is a lot higher. And the compensation fund is actually a form of insurance. Right, so guys, make sure that you see where the ticks go, and if you look at your other bullets in your booklets, please take a pen and find the statements and the qualifiers and mark it like I've done here. Right, and the last one of compulsory benefits is the RAF or RABS. Actually, guys, please get into the habit of now referring to this as the RABS. It stands for the Road Accident Benefit Scheme. Right. The Road Accident Benefit Scheme is for providing appropriate cover to all road users within the borders of South Africa. That is, guys, if you get injured on the roads in South Africa, all road users are covered. Now, guys, this specific one, it's not one of the bullets there, and it's not in your booklet, so please make a note. The Road Accident Benefit Scheme is financed through the fuel levy. Every time people fill up their cars with petrol or diesel or whatever, a portion of that money is allocated to the Road Accident Benefit Scheme, so that in the event that somebody gets injured on the road, they can actually claim from the Road Accident Benefit Scheme. The fund compensates a person in accordance with the Road Accident Benefit Scheme Act for loss or damage wrongfully caused by driving a motor vehicle. Now, guys, they say damage there, but it's actually not damage, it is injury. It's against injury. You cannot claim from the Road Accident Fund if somebody went through your gate and that happened on the road and the driver was negligent and he drove through your gate. I cannot claim for those kind of damages, but if I'm injured on the road, then that is what they will pay out. Right. The Road Accident Benefit Scheme provides a social security safety net to the country and economy by making available compulsory social insurance cover to all South African road users. Right, and of course, guys, the next one, the RABS indemnifies the wrongdoer from liability. Now, guys, if a person was a negligent driver and somebody got injured and you claimed a benefit from the Road Accident Benefit Scheme, it means that you cannot go afterwards and then go and sue him again and try to get money from him. That person is now indemnified. That risk was passed on to the RABS. So if you claimed from the Road Accident Benefit Scheme, you got compensated. You cannot do anything against the negligent driver. He is then indemnified, and it is that is settled. So please make sure that is what the last bullet point means. Right. Now, guys, I'm going to hand you over again to Mr. Edwards. He's going to take you through quickly through the different activities that you guys had in your booklet, and this is like the memo for it.
All right. So grade 12s, please make sure that you've got your booklets open, and hopefully you've completed the questions that are there. We're going to go through some of the answers for you. All right, so let's have a look at the first bit over here. So this is completing the following statements regarding the importance of insurance. So the first one transfers the what from the business to the insurance company. Let's have a look at the answer. The risk. So you're transferring the risk to the insurance company. Transfer of risk is subject to the terms and conditions of the insurance contract. Okay, the insurance contract. Number 3, protects businesses against dishonest employees. Mr. Van Zyl referred to that a little bit earlier. Number 4, protects businesses against losses due to the death of a debtor. Now, that's someone that may owe you money, but unfortunately they might pass away, so this insurance or this type of insurance would assist with that. Number 5, protects the business against theft of stock or damages caused by natural Natural disasters. Now, for instance, if you own some stock or anything like that, any assets within your business, here this and there's a storm or a flood or fire of some sort, this would cover those losses that you incurred there. Number 6, protects businesses from claims made by members of the public for damages that the business is responsible for. Number 7, businesses will be compensated for insurable losses, for example, destruction of property through fire. And number 8, businesses' assets need to be insured against damage and or theft. So you're transferring that risk of loss to the insurance company. Right, moving on to the next one. Indicate the type of insurance each of the statements below refer to. All right, so this is a form of Section A type question. So let's have a look at the first one. Number 1.1, insurance that the individual's businesses are compelled to take out.
Mr. Edwards, I just want to say, you can see there's a line under type of insurance because you need to analyze the question quite well, okay, before you answer this. So you will see later on through this, there's lines that's coming up to see which words we identify to get the correct term for that.
All right, so it's very useful during your exams to maybe have a highlighter available so that you can underline or highlight certain aspects of the question or the scenario that are important when answering your question. Okay, so 1.1, what are you compelled to take out? Mr. Van Zel's just reading through that section. That would be compulsory insurance, okay, UIF and road accident benefit scheme and COIDA. 1.2, the insured has the option of insuring against certain risks that may or may not occur. So you can see we've underlined may or may not occur. That would be short-term insurance, okay, something that's not necessarily going to take place, but is short-term insurance. All right, moving on to the next part. Indicate the type of compulsory insurance referred to in each of the statements below. I mentioned those 3. Now let's allocate those to the specific scenario that's given. 3.1, assist employees with financial aid should they become unemployed. There's a key, unemployed due to termination of the employment contract by the employer, UIF, Unemployment Insurance Fund. 3.2 provides appropriate cover to all road users within the borders of South Africa, Road Accident Benefit Scheme. And then 3.3 covers occupational diseases and injuries sustained by employees during the performance of their official tasks or duties. That is COIDA, the Compensation for Occupational Injuries and Diseases Act. Right, grade 12s. That brings us to the end of this section of work. That is perfect timing. So you've gone through insurance and hopefully you've learned a great deal this session, and it will assist you when going into your prelims. I think it's about 30 school days until you are stuck into your prelims. So wishing you all the very best for those exams, and yeah, I know you're going to do very well.
Okay, guys, thank you very much for bearing with us for this past hour. And guys, I wish you all the best for your 30 days that is left, and I hope you guys are going to do well. Thank you.